All right, guys, this weekend, the past 2 weeks has been very, very tumultuous in the overall market. We saw crude oil jump over 40% in a couple of days. We saw overall markets internationally start to vomit. So in today's video, I'm going to explain what I think is going to end up happening for the next steps of the market. We're going to take a look at the S&P 500, the Nasdaq, the Russell, the VIX, the crypto markets. We're going to tie it all together. We also have to take a look at the dollar, the yields, and the international markets as well. What is going on right now in the market is very, very historic. So we want to make sure that we approach what's going on in the market with respect and with patience. Because right now, instead of understanding that the same setups that have been working for the past year, 2 years, 3 years, in an environment like this, they do not always work. So we need to be cognizant of that, and we are going to be trading intentionally with intelligence. All right. So without further ado, let's get started with the video here. Okay. So first and foremost, this is the daily time frame of crude oil. All right. The reason why we're monitoring crude oil is because crude oil oftentimes has a negative correlation to what is going on in the overall market. With crude oil skyrocketing like this, oftentimes this goes to show that it is a very big hindrance to the overall international economy. Okay? With an expensive crude oil, it causes the overall goods and services of the world to be more expensive. Does that make sense? Simple supply and demand. If the supply of oil decreases, demand increases, and that causes a larger price. So if crude oil is more expensive, if gas is more expensive, then it costs more money to transfer goods. It costs more money to transfer bread, to transfer cows, to transfer chips, to transfer water, right? It costs more money to transfer these things because it uses oil and gas to do the transferring. So that is a big hindrance for the international community that cannot afford these things, right? So what we're seeing out of Europe right now is that Europe is undergoing very, very close to seeing a major recession because Europe receives the majority of its oil from the Middle East. And what we're seeing out of the Middle East right now is that not only are the oil refineries closing, the Strait of Hormuz is also closed. Right? So with those two things that's going on there, that caused this massive spike in crude oil. Now, with this massive spike in crude oil, given the fact that those macroeconomic details occurred, right? How much higher can we go? Because right now, we're up over 41%. Futures are about to open. We're about to see how much higher or lower crude oil just went, right? But this is as bad as crude oil has jumped up since the Russia and Ukraine conflict. So what I want to look at is what happened when Russia and Ukraine first had the conflict back in February and March of 2022. What occurred with crude oil price at that time? And it's important to realize and look at this because what happened in the past oftentimes replicates in the future. So let's go ahead and take a look at that, okay? Okay, so the main reason why we have to look at what is going on in the past is because we want to look at what happened when international relations were so bad that crude oil spiked. What were the similarities? What were the differences? And what caused crude oil to spike up this much, okay? So very simply, back in February of 2022, into early March of 2022 is when the Ukraine and Russia conflict began. If we take the percentage gain from the beginning of this move to the highs of this move, we will see something very, very interesting. We will see that crude oil is also up about 42%. Okay? Crude oil during that time, during the Russia and Ukraine conflict, was up 42%. We are currently up 41%. But now there's a couple of key differences. During the Russia and Ukraine conflict, oil production did not cease in the Middle East. They did not shut down oil production in these countries. So that in and of itself was something that was huge in today. But back in the Russia-Ukraine conflict, this caused still a 40-something% spike. What I'm basically showing is that the conditions now are much, much worse. And that is a two-sided, basically, coin. When the conditions are extremely, extremely bad, as they are right now, it will force other countries to try to intervene and try to create peace and stability. Does that make sense? Because imagine you have to... So here's the thing, okay? Number one, politicians want to get reelected. Okay? Number two, the way to get that reelection is that they want to keep goods and services cheap. They want to keep goods and services cheap so that the average person and the average consumer can say, oh my God, wow, the economy was great under this person. I want him to get reelected. That's the second thing. But right now, what's going on is that crude oil is getting potentially to a spot where it can be so bad that these countries are going to want to intervene. Okay? The reason for that is because the Chinese economy relies heavily on Iran's oil and the oil that comes out of the Strait of Hormuz. South Korea relies 60% of the oil from the Strait of Hormuz in the Middle East. Japan relies very heavily as well. Japan only has a finite amount of oil reserves because these countries are not producing oil or transferring it, right? So Japan has a finite amount of oil reserves. India receives 60% of its oil from the Middle East. So a lot of these international economies are not getting the supply of oil. That in and of itself is going to increase it. So now the other thing to realize is that, cool, the Strait of Hormuz is closed. If the Strait of Hormuz was closed and production was still going on, you can send in a bunch of tanker trucks. You can send in a bunch of trucks to transfer it in tankers and drive across the Middle East into Europe, through Jordan, through, into Europe, right? But they're not even producing it. So that is really bad. Does that make sense? So these countries stopped producing oil, and that means the funneling of oil is ceasing. So what we're seeing out of Europe, what we're seeing out of these other countries, what we're seeing out of Africa, East Asian countries as well, they are going to be met with a lot of backlash from their own citizens. Now, because they're going to be met with backlash from their own citizens, these countries' governments are going to be more implored to try to stop the conflict. Because at the end of the day, whatever interests these countries have within themselves, money is most important to them. So if it's hurting their pockets and if it's hurting their chances of getting reelected, if the United States, if the administration wants to get a good standing for the midterm elections, they do not want this conflict to maintain itself, right? They're going to try their best to cause the price of crude oil specifically to go down. Because with crude oil expensive, the average American is going to get hurt with this, right? So, essentially, right, within 10 days, back during that Russia and Ukraine conflict, crude oil ended up rising approximately 42%, a bit higher, right? But then interestingly enough, what ended up happening after this? So the way to look at that is we're going to take a look at the date range, okay? So from here to essentially, oh, sorry, the wrong one. It's the date range. Okay. So this took approximately 19 days or 13 trading days to hit the highs and then return back to the lows. Now, why is this relevant? It's because this shows that the move in crude oil does not often sustain itself to the upside. This is very, very interesting, important. Okay, so essentially, right? One thing that we have to realize is that institutions, they monitor these technical analysis indicators and overextensions to the upside and the downside. What we're seeing out of crude oil right now is that it's similar to what's going on right now, back in Russia and Ukraine. So crude oil, back during this Russia and Ukraine conflict, was very, very far overextended to the upside in terms of the Bollinger Bands. Now, what are the Bollinger Bands? They are the second degree standard deviation away from the 20 exponential moving average. This is a number and a statistic that hedge funds and banks monitor. It might sound very simple. Oh, Bollinger Bands, blah, blah, blah. But what it actually is, it calculates the standard deviation away from the midpoint. And the midpoint is the 20 exponential moving average. It's a very important number. So the reason why that's important is because when we are trading so far overextended to the upside or the downside, the price wants to return back into the mean. So when we're trading outside of the upper bands like this for so long, the price wants to return back into the mean. So we've done analysis here. We've looked at Bitcoin. We looked at the S&P 500, large tech stocks, even crude oil, right? The VIX. We're going to take a look at the VIX as well. But time and time again, when these structures and when these instruments are trading very far overextended to the upside, they want to return back in. The upside move does not always sustain itself. So that is essentially what we saw back in 2022, when this move in crude oil was worse than when the US was in Iraq. Okay? This was worse than any other sort of situation that really occurred in terms of an international conflict. So we're using this as a baseline. That's why we're using this as a baseline, because this was the worst case in terms of how high crude oil ended up spiking. Okay? So back then, crude oil ended up hitting 130. Right now, crude oil is only $90. Of course, also back then, there was more money circulating. Interest rates were lower as well, right? So it was easier on the average consumer. With crude oil being this spiked up, it wasn't as hindering to the average person. But what we're seeing right now is that interest rates are higher, and we still got the same percentage increase in the crude oil. We also saw that these countries absolutely closed their supply of oil. The Strait of Hormuz is closed, and these countries stopped producing. Those two things in and of themselves make this situation that's going on currently way worse. But we have to stick to the numbers, right? So what I want to do is simply what I ended up doing was I essentially got the candles of this entire Russia and Ukraine move, and I want to overlay it on the current situation. Okay? So let's go ahead and do that together. Okay? So very, very simply, what we're going to do is we're going to click on the bar pattern in TradingView, and we're going to go from the first initial phase of this move to the phase where we come back and retest, which was from essentially February 25th, 2022 to March 16th, 2022. And this is what we end up getting. We get a nice little Burj Khalifa pattern here. Okay? What I'm going to do is I'm going to put this same pattern onto the current price of crude oil and see if it's similar. Okay? So here it is. And let's go ahead and put it onto the current price. Let's get the screen in line. You guys can see all this. Perfect. Okay. All right. All right. So you guys could see this, hopefully. Perfect. Okay. So this is what the overlay looks like. And it looks very, very similar. Oddly enough, right? This looks very, very interestingly similar. We got the initial move. The current price of the Bollinger Band, guys. Also keep your eyes on the current situation with the Bollinger Band as well. We are trading very far overextended to the Bollinger Band. Very similar to what was going on in the Russia and Ukraine conflict back in 2022, right? So we are very overextended. And then boom, we had another move to the upside. And then boom, we had another move to the upside. And now we are still almost exactly at the same percentage gain as we were back in February of 2022. February, there was a 42% gain. Right now, it's about 41.5. Very, very similar. Very, 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 very similar. So February 2022 into March, the Russia-Ukraine conflict, this looks very similar to what is going on right now. Now, it's not an automatic guarantee, right? And just for the sake of really checking when price should revert back, that would essentially give us until March 16th or March 17th. By that point, if history repeats itself, we should see crude oil back below $75 by March 16th or March 17th. So how many days would that be in from now? That would be about 10 days from now, or 6 trading days. 10 days from now or 6 trading days would cause us to be at below 75 if history repeats itself. Now, we're not saying that it will, right? This is the best that we can do. We look at the worst case scenario of how similar situations are, and then this is essentially the best that we can do, right? What we have to also realize about this situation is that it is way worse. And now I also gave you guys my thought process of why these countries would want to intervene since it is way worse. The situation currently is way worse because the Strait of Hormuz is closed and because these countries in the Middle East stopped oil production. Because these countries stopped oil production and the Strait of Hormuz is closed, it hurts people's pockets way worse. It is way worse for the international community. It's not just bad for Russia as it was back in 2022. It's really, really bad for the international community because Europe used to get a lot of their oil from Russia. They stopped getting their oil from Russia. And now they can't even get their oil from the Middle East because the Middle East is closed. That puts a big target on the European economy. This puts a big target on the Middle Eastern economy. And this puts a big target on the East Asian economy. India receives 60% of their oil from the Middle East, 70% of the oil from the Middle East. South Korea receives 60%. China receives a big portion of their oil from the Middle East and Iran, the Strait of Hormuz as well. And it causes Japan. Japan has a very finite amount of oil reserves. So my thought process on crude oil, to really, really drive this home, is that because this situation is way worse than it was previously, a couple of years ago, that these countries are going to try their best to stop the conflict. Because if the conflict continues, then it's going to implode a lot of different countries' economies. And I don't think that they want to do that. They could. By all means, they could. But the chances of that occurring it would be very, very shocking because it would basically guarantee that everyone in power in these countries right now would not get reelected. All of Europe, all of these European countries, the far right, not even far right, whoever is in charge of these European countries, whether they're liberal or conservative, none of them are going to be reelected if they support what's going on in the Middle East because it's going to cause prices to skyrocket. If crude oil continues to skyrocket at the pace that it should be, it's going to hurt the average consumer. It's going to cause everything to become more expensive. And I don't believe, if I'm a sound-minded politician, if I'm a sound-minded person that's in charge of one of these countries, you're going to try to get down to the negotiating table, and you're not going to want this to continue. Okay? Because it's really, really bad. What's going on with crude oil back in Russia, Ukraine, was worse than the U.S. invading Iraq. And, it looks very, very similar. We had very, very large spike ups. And according to the Russia-Ukraine analog, we are back at that same price today. Friday's close was basically at the same movement to the upside. Now, heading into Monday, what we have to see is if this is going to be the high. And if this is going to end up being the high, then the Russia-Ukraine analog is going to end up playing out, and we should see a price below crude oil of 75 by March 16th, which is about 6 trading days from now, or 10 days. Okay, so that's the best that we can do. I'm not going to sit here and just say, oh, we go short, but this is one parameter that we're looking at: crude oil. We have to look at crude oil. The second important thing that we're going to look at is the VIX. Okay, we have to monitor what's going on with the overextension to the upside in the VIX, because it's going to help us really understand how much further or how much higher stocks can go, because we have to look at everything all in one. All right, so all right, guys, so this is a daily time frame of the VIX. Okay, now why do we monitor the VIX? Very, very simply, why do I always monitor the VIX? Is because the VIX has an inverse relationship to the overall market. The VIX literally does the opposite of what the overall market does. Now, why do we monitor the VIX if it just does the opposite, right? What we have seen time and time again is that when the VIX is trading outside of the upper standard deviation, the upper Bollinger Bands, as we just looked at on crude oil, when the VIX drops, right? When the VIX drops very, very heavily, the S&P 500 bounces time and time and time again. So this is just an added indicator that we have to look at. Okay, so to really, really drive this home is I can prove it to you guys right now. What we're going to do is we're going to overlay the price of the S&P 500 over this chart to see, okay, Hamid is saying every time we drop in the VIX, the S&P 500 ends up bouncing. So let's go ahead and take a look at that, okay? Yep, so essentially the VIX monitors the volatility of the market, and when the VIX, when the overall market drops, it increases volatility, okay? So, very simple. Let's go ahead and put the chart of the SPX, overlay it on this chart of the VIX. All right, here we go. Okay. Okay, guys, let's take a look at this. All right, nice and simple. So what we're seeing right now, one second. Okay, so this is essentially, this line is the S&P 500, and obviously the candles are the VIX, okay? So one of the easiest things to do is when the VIX, we have to monitor when the VIX has overextension. Why this is important? Hamid, why are we looking at this? I just want to look at stocks. What's the point of this? When the VIX is trading outside of the upper level of the Bollinger Band, the stock market historically ends up bouncing. Now, I'm not saying this is going to continue, right? But time and time again, when this does occur, we see bounces out of the S&P 500, okay? So let's go ahead and take a look at a bunch of different times this year, all right? So the VIX, back in February, we were trading outside of the upper bands. The SPY dropped very dramatically, right? What ended up happening on the SPY when the VIX started to drop lower? So the VIX dropped lower, right? And then the SPY bounced very aggressively. Back over here, the VIX was skyrocketing, caused the SPY to drop, right? The VIX over here, outside of the upper bands, very, very far overextended, showing extreme overextension to the upside was the VIX, right? Outside of the upper bands was very, very bearish. Everyone was very scared at that time as well, right? Every single time the VIX was trading outside of the upper bands, the average person, average retail was very, very fearful. Everyone thought that this was the beginning of a bear market. The market was going to drop. The SPY did drop. It did play into people's feelings. But because we were so far overextended to the upside in the VIX, numbers drive this market. Market makers drive this market, not fear of retail, right? So because the VIX was so far overextended, algorithmically overextended, mathematically overextended, it was not going to sustain itself, which is why when the VIX finally returned back to the mean within the second standard deviation, return back into the mean, right? Because all the Bollinger Bands is it just monitors the standard deviations to the upside or the downside. Okay? When the VIX started to pull back, all right? And this is just the VIX ticker, VIX. Nothing complicated, right? When the VIX starts to pull back lower here, right? The S&P 500 once again started to bounce very, very aggressively. Time and time again. Let's go back to the most extreme example because it happens every single time. Every single time. Right here, back in November 2025, I even overlaid it for you guys here. When the VIX was very far overextended, once again, outside of the upper bands here. Once again, when the VIX started to pull back, the SPY, this is the chart of the SPY, started to skyrocket. Back again, back in October of 2025. VIX was very far overextended according to the Bollinger. Once again, it just keeps on repeating itself. The SPY, this line right here, started to skyrocket. Okay? Time and time again. All right? Last example. I really don't want to... We could just go through every single example, but there's no reason to. Last one is this back in April. If you guys remember how bearish the market was back in April, the VIX really told the story. Okay? So back in April, the S&P, as we can see, really, really dropped very dramatically. It was very, very, very weak. This was back when everyone was like, all right, okay. We have been skyrocketing way too much. This is going to be the start of the bear market. But this was not the same, right? We got a very far overextension to the upside once again, according to the VIX and the Bollinger Bands. And don't get confused, right? The charts might look, there might be a lot going on. It's very, very simple. Don't be confused. The candles are simply the VIX, and this blue line is simply the S&P 500 overlaid on top. Okay? All we're looking at, and this should really drive it home, is that when the VIX is very far outside of the upper Bollinger Bands here, the VIX wants to return back in. It cannot sustain itself to the upside, right? So because it can't sustain itself to the upside, it pulls back. So when the VIX pulls back, the argument and what goes on in history is that the S&P 500 bounces. And it ends up bouncing very, very aggressively. Okay? So that is something that we always need to monitor. Now, why did we go over this spiel for so long? Is because the VIX is once again trading outside of the upper bands. That is why it is so relevant right now. This is so relevant right now because the VIX is once again trading outside of the upper level of the Bollinger Bands. And it just so happens that the S&P 500 is also showing a lot of weakness. Of course, you guys know, if you guys have been monitoring or watching the market in the past week or two, the stock market is down. And the VIX is very far overextended. So, I'm not saying that this is going to pull back now. I'm not saying that the VIX is going to now just start pulling back. Because we saw back in April, it had another move to the upside. So we can easily have another move to the upside. But up here, when the VIX is so far overextended, it's the time to start looking for bullish opportunities in the stock market. Now is not the time to be short-term. Now is not the time to be long-term bearish, in my opinion. It's better to look for longing opportunities. All right? So what goes on with the... so essentially, what goes on in the S&P 500, or the ES, right? The same will apply in the Nasdaq, because they both move very, very similarly, right? So if the VIX ends up falling if the VIX ends up falling, not only will it cause a bounce in the S&P 500, but it'll also cause a bounce in the Nasdaq, right? So that is essentially what we look at. Well, the S&P and the Nasdaq. So that is also, it also affects the crypto market. It affects gold. It affects silver, metals. And yeah, so what did we just look at so far? What did we just look at so far? So now to really, really drive this home, everyone, to really, really drive this home is we are not as overextended. And the reason for that, yes, we had a big green candle. But the problem is that what we need to look for is multiple days where we are opening and closing outside of the lower bands. What we just saw recently is just one large green close outside of the upper bands. This is not a multi-day overextension. Right now, the Bollinger Bands, and this is really unfortunate, right, for the market because it can lead to a lot more weakness. But this is pragmatic, okay? We're not just blindly bullish. We're not just blindly bearish. We have to look at things pragmatically, okay? So this right here, back in January, this is extreme overextension because we opened and closed outside of the bands, very, very far outside of the bands. This was very, very overextended, okay? We gapped up very, very hard, very overextended, right? My argument is that when we open within the bands and then close outside with 1 day, it's not as overextended as if we opened and closed outside the bands. Does that make sense? This is way worse for the VIX. It's way worse for the market, okay? And back here, when we did end up, for example, in November, right? Right here in November, we had 2 days where we opened and closed outside of the upper bands. This was way more overextended than what we just see right now. Yes, we saw a big green candle recently, but once again, guys, just realize when you have multiple opens and closes outside of the upper bands of the VIX, that is what truly causes overextension. So yes, we are overextended, but to get really, really overextended, and what we really, really want to, it would be like very easy to judge the direction of the market, is if on Monday we gap up even higher on the VIX and we close outside of the bands on the VIX. If Monday does that and we see a huge move in the upside on the VIX, volatility in the market does not sustain itself like that without pulling back first. I personally think the market should see a bit of a pullback and then a continuation upwards if the market is bearish and the situation in the Middle East does get worse. But this is not true complete overextension because we haven't seen multi-day opens and close outside the bands. Okay? Very, very simple. So there's a bit more room to drop in the market. Now is not the time to throw the kitchen sink. Especially over the weekend, it's really difficult to throw the kitchen sink at the market. What helps you throw the kitchen sink, you have to monitor with also longer term positions and safe position size, is, guys, I'm telling you, when the VIX for multiple days in a row opens and closes outside of the upper bands, that's what leads to a sharp pullback in the VIX. And then when the VIX has a sharp pullback, that's what causes the overall market to get a sharp bounce time and time again. Okay, so that's that for the VIX. Next, let's go ahead and just quickly take a look and go through the dollar. We're going to take a look at crypto. We're going to take a look at the large tech stocks, because monitoring the large tech stocks, you have to monitor the large tech stocks because those are the main drivers and where most of the money is in the equities market, in the stock market. So we're just going to simply take a look at all that stuff, okay? So let's go ahead and just do that. So this is the daily time frame of the dollar. And why we look at the dollar is because it has an inverse relationship to the market right now, right? What's going on with the dollar is very, very important for the equities market. It's very, very important for the equities market, okay? So why are we monitoring the dollar? Why are we monitoring the crude oil? Why are we monitoring the VIX? Why are we monitoring all these different things? Because the more data that we have, the higher probability we have for a move to continue. Simple, okay? So pragmatically speaking, when the dollar is rising, when the dollar is bullish, that means people are taking money out of their stock positions. They're taking money out of crypto. They're taking money out of their gold, out of their silver, commodities, and they're putting it into the dollar, which causes the dollar to spike. Okay? That is the relationship. Inverse relationship, similar to the VIX. Okay? Now, where is the dollar on the chart? Where is the dollar on the chart? The dollar is sitting at a level of resistance. 99.50 is a very, very important level on the dollar. Time and time again, when we approach this level, it has acted as a very, very, very clean level of support and resistance. Time and time again. Okay? So this is really, really just an important level. Okay? So where are we right now? We are back at that level. We are tapping right on this level right here. Approaching with strength into a level of resistance causes resistance. Okay? You don't want to go long into the dollar. Generally, right? You don't want to be bullish into a large move to the upside into a level of resistance. When you're day trading, for example, when you are trying to catch a move to the upside, when a move like this has already happened, and, there's major resistance up here, after the move has already happened and we hit the target to the upside or the major resistance, going long here becomes a gamble. And it becomes very, very unsafe. It's not a high quality trade setup. Now, the problem with this is that the dollar is moving like this based off of crude oil jumping and based off of the VIX bouncing. So, pragmatically speaking now, right? It's not giving as clean of a situation as what the VIX was showing. It's not giving as clean of a situation as crude oil, right? The dollar is also at a level of resistance. If the dollar maintains this level of resistance, as we've seen in the past as well, time and time again, the dollar should fall. If the dollar should fall, the market should bounce. Okay? The opposite occurs in the dollar and in the stock market. So that is currently the situation, right? Not a guarantee, right? It's not a guarantee, but this is one other aspect. It's one other data point that we have to pragmatically look at, okay? The dollar is sitting at a level of resistance. We should fall. If it doesn't fall, so be it. But if it does fall, the opposite occurs in the S&P 500 and the opposite occurs in the overall market. So that's that for the dollar. All right, guys. Next, I want to start off with just by looking at Apple. All right. What we're going to do now, I'm going to quickly just go over the large tech stocks. And just as a group, we're going to see whether this looks bullish, whether it looks bearish, whether it's leaning to a bounce. Okay. Nice and simple. So Apple. Okay. A daily time frame of Apple. And why are we looking at these large tech stocks? Because these are multi-trillion-dollar companies. And if we're bullish on the S&P 500, or we believe the S&P or the Nasdaq should bounce, it's going to be heavily, heavily dependent on these multi-trillion-dollar companies. Okay? Very simply. So what are we seeing out of Apple right now? Does this pragmatically look strong or weak? Does this pragmatically look strong or weak? In my opinion, right? I would rather want to see Apple comfortably hold above 262. But does this look extremely bearish? Not extremely bearish, but it doesn't look strong. Okay? Pragmatically speaking, it does not look extremely strong, but we are holding at support. 255 is support. Unfortunate situation for Apple. It's not giving as clean of a, overarching analysis on the chart, but it's sitting at support below a major level of resistance. If it can break back above 262, 263, then it could reclaim back its overarching bullish momentum. Okay, there's that for Apple. Let's go ahead and take a look at Amazon. Okay, Amazon. Pragmatically, we have to be pragmatic about this. Leave the emotions at the door. Pragmatically speaking, Amazon had a big bounce to the upside. We hit essentially 220 at a level of resistance, and we got to pull back. Amazon is also trying to basically fill the gap that occurred back due to earnings. And it did fill this gap. And of course, once we fill the gap after a big aggressive move to the upside, having a bit of a pullback is normal. It's profit taking. It doesn't mean that the market is bearish. It just means that all of the people that ended up going long down here or going long down here on this big aggressive move to this gap fill, all right, once we hit this gap and the price hit, good opportunity to take some profits. This move to the downside, in my opinion, was simply just that. It was just bulls taking profits on the move to the upside. Because what we just saw out of Amazon over the past couple of days was Amazon was up about 9%. Is that bearish? If Amazon is up almost 9% in the past couple of days, that's not bearish, right? So we have to be pragmatic. Amazon is holding above 210, right? If anything, this looks way more bullish than Apple, correct? So Amazon and Apple, we just checked them out, all right? If Amazon can hold above 210, then we can break above this very, very major level of resistance here at 222. If it breaks above 222, then all eyes are going to be back above 230, and then we could see new highs. And then we could see a big rally into spring. But these are the levels, right? So now, pragmatically speaking, if Amazon can hold above 210, it looks decent. It looks way more bullish than Apple, okay? There's that for Amazon. Now, let's go ahead and take a look at Meta. Meta does not look as bullish as Amazon, right? It didn't just have a huge spike to the upside, but what is Meta doing? Meta is holding support. It's consolidating at a major level of support. And right at the lows of this level of support, correct? So at the lows of support down here, it's holding above 630. Okay? This is not the time, in my opinion, to start going short. In my opinion, as we approach and as we continue to consolidate at these levels of support, the longer we remain at these levels of support, the higher the likelihood chance that buyers step in and create a floor. That's what they're essentially doing. They're trying to create a floor on Meta above 630. This is not extremely bullish momentum, but it also is not bearish momentum. So the fact that we're holding support, if anything, is better than breaking down lower. Does that make sense? So Meta is holding support, okay? Netflix. Netflix is another really big company. We were long Netflix. These contracts are up really nicely for us, and we're doing really well on Netflix. What is going on with Netflix? No pullback in sight. Showing a lot of strength. When a large tech stock, the main thing, right? Keeping biases outside. No bias. When these large tech stocks are showing this much strength in the stock market, does that mean that investors and banks and hedge funds are afraid? No. If the overall market was crap, if the overall market was going to pull back and drop very aggressively, you wouldn't see stocks like Netflix even do well. That is my thought process, okay? Netflix, a large company, would not be doing well if the overall market was really weak. Now, it's not a guarantee, but the fact that Netflix is trading comfortably above this prior level of resistance at 96, 97, and we are tapping on the $100 level, we can quickly see 105, 110 in the next coming weeks. That's amazing. That's really amazing for us, and let's see if we hit that. But essentially, Netflix looks bullish. Amazon looked bullish. Apple did not really look that bad, but then Meta was holding support. So that is what's going on so far on the large tech stocks that we saw. Okay. Next, let's go ahead and take a look at Microsoft. What's going on with Microsoft? Microsoft got a really nice bounce off of the lows. Okay. Microsoft off the lows, trading above 405, tapped above 410. It's up 8% in the past couple of days. This is a really nice bottoming out situation. If Microsoft can maintain above 400, we can see back to 430. Would you want to be bearish down here when the price of these stocks are starting to bounce? In my opinion, no. Does that make sense? I would rather be bullish or look for buying opportunities in these stocks. Now, I'm not saying we can, futures open very quickly. Futures open really soon. The futures market can be gapping down based off of what we saw over the weekend with the international conflict. But pragmatically speaking, if that conflict was not occurring, what we're seeing out of the analysis on these large tech stocks, what we're seeing on the VIX, what we're seeing on crude oil, there should be a bit of a move to the upside so far on these large tech stocks. We haven't even taken a look at Google or Nvidia, the chips. But so far, based off of what we saw, they're trying to bottom out or they're trying to hold support. Does that make sense? So if if Microsoft can hold above 400 and really, really hold above 405, this is really, really solid pullback, and it really, really wants to bounce. We could see 420, we could see 430 quickly. Okay. Next, let's go ahead and take a look at Tesla. What is Tesla doing? Tesla is creating a falling wedge pattern into a level of support at 390 into this 380 level of support. Okay. Falling wedges are extremely bullish patterns. Falling wedges are extremely, extremely bullish patterns. They oftentimes bounce very aggressively. Okay. We are creating a bullish pattern into a level of support while these other large tech stocks are trying to bottom out, while the VIX is overextended to the upside, while the crude oil is overextended to the upside. We're going to take a look at the S&P and the Nasdaq. They're also overextended to the downside. There's a lot of different factors that can lead to a bounce in the overall market. That's the best that we can do. We can't really, time it perfectly, but we can use our process of deduction and do the best that we can. That's the best that we can do. We're not always going to be correct, but we want to have the numbers on our side. So right now, the numbers with Tesla, if it can hold 380, we could drop down a bit lower to 380. We're creating a falling wedge pattern. This is really, really bullish. If we maintain above 380, 390, listen, Tesla has a lot of room to the upside. Microsoft has a lot of room to the upside. Meta held 630, a lot of room to the upside. Amazon was bouncing really aggressively, has a lot of room to the upside. So this is a really, really interesting. Yep. So this is Tesla. Really, really interesting situation that we're seeing out of the market right now. And to really, really drive it home, let's take a look at Google. Okay. So Google has been an absolute winner for months. Has been an absolute winner for months. And this is the last large tech stock. We're going to take a look at the chips after this. But Google has been an absolute winner for months. Okay. Warren Buffett went long on Google down here in the 240s to 250 range. Okay. In the 270s range. Okay. So if Warren Buffett ended up going long down here, basically into all-time highs, Warren Buffett went long. Does that mean that he's bearish on Google? Are we just going to only have a couple of months of bullishness? Or is he willing to hold Google over a long period of time where he thinks that Google is going to be a winner? Because one of the last trades that Warren Buffett made was he went long Google over here in the 270s, 280s range. Huge play, right? So with that being said, what is going on with Google right now? We are getting back to around 290 as a level of support. We did break below the 296 level, as we can see here. We're being pragmatic. Okay, we're being pragmatic. We're not, being extremely biased. Google did break below this level of support here. We opened below, but then we closed back above it. This is not the most bullish. Obviously, when you look at this, you can feel the bearish momentum. It's not the most bullish situation. You could feel the bearish momentum. All right. So that's that for these large tech stocks as a whole. Next, we're going to take a look at the chips, Nvidia, AMD, and the Semiconductor ETF. Okay. So what's going on with Nvidia? What's going on with AMD and these chips? Okay. Why is this important? The Middle East has a lot to do And what's going on in the Middle East has a lot to do with chips, because these chip plants are going to be running on water. There needs to be a lot of space where this can occur. And these Middle Eastern countries really took the initiative to be involved in a lot of this development and a lot of this production capability. With this occurring in the Middle East now, it's not as safe, or these chip stocks are not showing as much strength as a whole, especially Nvidia and AMD. AMD did have a big move to the upside, but pragmatically speaking now, what can we do? All right, what can we do now? We just have to look at the support and resistance and see how much room we have to the downside or how much room we have to the upside, okay? So Nvidia is currently trading, very, very colorful chart. I know, lots of different colors and everything. Just don't get confused. I have to clean it up, but these are all the very, very major levels, all right? You can clearly feel the bearish momentum out of Nvidia currently, okay? But what's interesting on Nvidia is that the lower level of the Bollinger Band is sharply and aggressively bouncing higher. What does this show? When Nvidia is sharply, aggressively bouncing higher, the lower level of the Bollinger Bands, it means that the move to the downside, the standard deviation to the downside, is increasing. So it would mean that a move to the downside would automatically cause it to be overextended to the downside in terms of the Bollinger Bands. When that occurs, it means that it's likely to want to bounce and return back into the mean, into the Bollinger Band. So that is the one saving grace that we see out of Nvidia's price action right now, is the Bollinger Band, lower level of the Bollinger Band increasing to the upside. Okay, so that's that for Nvidia, right? I hope this made sense in terms of the Bollinger Bands and everything else as well. Next, let's go ahead and take a look at AMD. All right, what is AMD doing? AMD, during this entire tumultuous situation in the Middle East, is still holding above 188, and it's still holding above 190. This is not an extremely bullish scenario. This looks very similar to what's going on with Meta, right? Meta is also a very, very large tech stock, not showing bullishness, but it's holding firmly above levels of support. When we are holding firmly above support like this, it goes to show that there is potentially a bottom being formed, okay? So with this bottom being formed on AMD, with this bottom being formed potentially on Nvidia, with the Bollinger Bands moving higher as well, with the bottom being formed on all these large tech stocks, one has to assume that the overall market is trying to find a bottom, all right? And the last thing that we're going to look at for these chips is the Semiconductor ETF, okay? So this is the Semiconductor ETF. And what were we just looking at with the Bollinger Bands? When you are trading outside of the lower bands, when you're trading outside of the lower standard deviation to the downside, chances are they want it to revert back into it, okay? They want the price of this to revert back into the lower standard deviation, okay? Oh, sorry about that. Let me go ahead and bring that back. Okay? So, what we're seeing right now is the SMH is very far overextended to the downside. Very, very far overextended to the downside. This usually leads to a bit of strength or a bit of a bounce, because now is not really the time to go short. When something is trading outside of the lower level, it's not that safe to go short. And the reason for that is, if we look in the past, what happened when we were in the lower level back here in November? The price of the SMH bounced very aggressively, right? What happened when we were here in September? We were trading outside the lower level over here. What happened with the SMH? We ended up bouncing very aggressively, right? Again over here, bouncing very aggressively. What happened back in April when the overall market was capitulating and showing a lot of weakness? This continued to drop, right? By all means, it did continue to drop a bit lower, but we eventually found a bottom and we reverted back the entire loss And then in the next coming months, we made new highs. Okay? So when things are this far overextended to the downside on these big names, on these big players, chances are price wants to return into the mean and it wants to bounce. That's when buyers usually step in. Okay? So what we're seeing right now out of the SMH on the semiconductor ETF is that we are very far overextended to the downside. And because we're far extended to the downside, chances are is that soon we should get a bounce. So we just looked at multiple different scenarios and multiple different times in history where that did occur. Okay? So I hope that makes sense. Hope that makes sense, and I hope you guys enjoyed that. All right? Now, we're going to go ahead and take a look at the S&P 500, the Nasdaq, and the Russell 2000. Okay? And then we're going to top it off with crypto and other stocks as well. Okay? So, this is a chart of the S&P 500 futures. And what I want to do is I want to put, it'll just be easier to look at the SPY. So you guys will get a better understanding of what price the overall market can end up going down to. Okay. So right now, I simply want to show you guys the 200 simple moving average. Okay. This is the 200 simple moving average on the SPY. The target to the downside is around 656 currently. As we can see, the 200 simple moving average is sharply increasing. Okay. In the next coming days, the 200 simple moving average should be around 660 on the SPY, which is approximately another 2% down, 1.5 to 2% down. Okay. So now that we just looked at the SPY, right, it's easier to now just look at what's going on a cleaner chart. Okay. This is a cleaner chart. Now you guys know that we can drop to 660 on the SPY, another 1.5%. Okay. What are we seeing out of the SPX? We are trading outside of the lower level of the Bollinger Band again. When you're trading outside of the lower level of the Bollinger Band like this, what did we just see with the SMH? Price tends to want to bounce. When things are this far overextended to the downside, you do not want to be extremely bearish. You want to rather look for good long opportunities, in my opinion. That's what we're going to be doing. We're going to be looking for solid, safe, longing opportunities. When we're trading, opening and closing outside of the lower standard deviation to the downside, this is when you start to lean long. Yes, by all means, we can drop even further. We can drop down to the 200 simple moving average. We could drop another 1.5%, 2%, by all means. But with crude oil overextended to the upside like that, with the VIX overextended to the upside like that, with the dollar at levels of resistance, with these large tech stocks at support, and with the S&P 500 very far overextended to the downside, multiple different variables are showing that the market wants to soon bounce. Now, of course, listen, it goes against logic. That's the issue with catching bottoms and tops. It goes against logic, right? When there's clear-cut weakness, for someone to say, oh, Hamid is saying to go long, oh, he's going to lose money, whatever. Time and time again in history, every single time something like this has occurred, I tweeted it, I would enter the trades, I would be very public with what I'm doing. Time and time again, it's worked. It's because we allow ourselves time on the trade as well. We don't have, options expirations that expire next week. Oh, yeah, it's going to bounce this week. No, that's gambling. We don't do that, especially into this extreme weakness. What's the point of doing that? So you can post a screenshot. There's no point. The goal is to make money in a nice, simple, safe manner. Okay? We want to make money in a nice, simple, safe manner. And to do that, when we are very far overextended to the downside, for swing trades, you want to be comfortable. You want to give yourself some time on the trade. Give yourself a couple of months. I'm not your financial advisor. This is not financial advice. But you want to give yourself some time. A long enough time horizon. That's what you do. All right? So that is something that we have to really, really, ingest. Because yes, the closer dated option contracts are way more cheap You could buy way more. You can make way more money on the cheaper ones. But that's not safe. That's how you lose money. That's how you are not able to trade anymore because you lose your portfolio, right? So keep that in mind. So far, the S&P 500 is very far overextended to the downside. What we saw with the IWM is also very, very far overextended to the downside. This is something that we cannot ignore. When the Russell 2000 fund is this far overextended to the downside, for you to be bearish into this weakness is complete manipulation. You are being manipulated by the market if you want to be bearish into this weakness. Because yes, sure, we can drop even lower, but this is the time where you have to start looking for long opportunities. We time and time again in history, for you to be bearish into this extreme clear-cut weakness, because yes, by all means, this is April. This is April on the IWM daily time frame. Yes, by all means, right? This could be that move that we just saw on Friday, and then we could have an even more explosive move to the downside, right? By all means, guys. But because the move to the downside does not sustain itself at this vigor and at this extreme, what happens within a month, 2 months? What happens within a couple of weeks? The price of the IWM ends up bouncing very aggressively and breaking above the pullback zone and ends up making new highs. Okay, so that is my point. By all means, we could, we dropped another, 6-7%. Gap down, right? By all means, we could do that again. But it doesn't make sense to chase the shorts. It does not make sense to short the whole. You want to go long into weakness, and you could average in. That's essentially what the concept is right now with what's going on in the overall market. And last but not least, let's go ahead and take a look at the Nasdaq. The Nasdaq is not as overextended to the downside as the S&P and the IWM. The IWM has a big influence on the S&P 500. With the IWM this far overextended to the downside, of course it's going to have an impact on the S&P 500. The Nasdaq looks very, very similar to a lot of these other large tech stocks that we saw. It is holding support. It's trying to hold above 595. It's trying to hold within 600. Okay? Doesn't look too strong, right? But pragmatically speaking, we are at a level of support on the QQQ. It is trying to consolidate at a level of support. So, with that being said, to wrap this whole thing up now, right? The large tech stocks are at levels of support or trying to show some strength. Crude oil very far overextended to the upside. The VIX very far overextended to the upside, but they still have room to go. The large tech stocks, the Nasdaq, the S&P, still has room to drop lower. So it's nearing a point where the market is going to soon, in my opinion, find a bottom and start to bounce, in my opinion. Unless, something really, really bad happens. And to wrap this video up, let's go ahead and take a look at crypto. Okay, so now to wrap this up, we're going to take a look at crypto. All right, so this is a daily time frame of Bitcoin. And this is my analysis. This is my indicator on Bitcoin. Okay, so what I really, really liked out of Bitcoin here is that, and why I wanted to be a bit bullish on crypto down here, is because with the overall market basically at, terrible things going on internationally. Lots of huge news going on internationally with crude oil, the VIX, everything, right? But what did we end up seeing out of Bitcoin? What did we end up seeing out of the crypto market? We ended up showing support. We consolidated at levels of support, and we did very, very well. It did not make any new lows. As the market was showing a lot of weakness and making new lows, what ended up happening with Bitcoin? All right, so Bitcoin, crypto in general, we bottomed out like this. Okay? So what are we doing? So why am I looking at crypto like this? Why crypto is just another variable to look at what's going on in the strength or the weakness of the overall market. If the overall market was extremely weak, crypto would be capitulating. Does that make sense? So, but because we saw a consolidation here out of Bitcoin, because we saw a consolidation here out of Ethereum, right? Because we saw a consolidation out of Solana, right? This gave a good indication that the market in general is not as weak as people are essentially believing, right? So I began to be very bullish. I tweeted that crypto was going to bounce. And within a couple of days, we ended up getting a really, really nice 10-15% bounce out of Bitcoin, out of Solana. And it worked out really, really well. So does that mean that this is going to be the low? Of course not. We could easily drop down. Of course, crypto had a lot of bearish headlines. Everyone was expecting a big move to the downside to 45, 50K, right? But what was interesting is that the majority of people were extremely bearish on crypto. They were very, very bearish on crypto. What ended up happening? We jumped up 10-15%. Back here. So back here, right? When everyone was extremely bullish on Bitcoin. Oh my God. Oh, we're going to see 200K. Everyone and their mother was like, oh, it's going 200K by the end of the year. Oh, we're going to be very, very bullish. When the majority of people were bullish, what ended up happening? The market ended up dropping very, very dramatically. When the majority of people were bearish at a level of support, when the majority of people were bearish, what ended up happening? The market ended up bouncing. Okay? So this is clear cut. You have to just do the opposite of what the masses are doing. You have to not be manipulated by price action, and you have to trade logically, intuitively. Okay? This is why we look at the crude oil, the VIX, the large tech stocks as a whole, crypto markets as a whole, the S&P 500, the Nasdaq, and the Russell 2000, as well as the dollar. Everything as a whole. We have to look at these things in unison, because the more data points that we look at, it gives us a better understanding of what the next steps are in the market. Okay? So that's that, man. That's that. So I hope this makes sense. We can quickly do an analysis on the metals as well. I didn't go over gold and silver. But once again, gold also holding above 5,000 is very, very bullish. This is a very, very important sign and important time for gold. What happened? Gold held 5K, right? Gold held 5,100. It's a really, really nice move to the upside. It's still holding support, right? Silver is also trying to hold, right? Silver is trying to hold $80. Gold and silver are trying to hold support while the overall market is falling. So we just fell to major levels of support on metals. This is very, very important. Okay. So now this is what's going to end up happening. If the VIX ends up pulling back, if the market ends up bouncing, this in hindsight is going to be an amazing support level to be held. Okay. Because if we're also looking at this is silver, right? Let's look at this in terms of a risk reward. So say, for example, we ended up going long at 83.50. Stop loss would be, let's say the stop loss, wide stop loss. Okay. Let's have the stop loss prior to below this low right here. Okay. You see this wick. The stop loss is below this wick. All right. Nice and wide stop loss. Okay. Let's remove this. Nice and wide stop loss. The target would easily be above this right here, right? The prior, the breakdown point at 96 would be the target. This is still almost a 2.5 to 1 risk reward ratio. This is still a really, really solid opportunity to have gone long. Does that make sense? It was even a better opportunity to have gone long closer to the open. This makes it almost a 3.5 to 1 risk reward. So that's why the risk reward in terms of these metals right now The risk reward in terms of the bullishness of these metals right now is really, really good. So that is unfortunately, the situation for bears, especially, right? You don't want to be extremely bearish. The risk reward on silver is very, very good, but a lot of the strength is going to be going into gold and everything like that. But listen, guys, this is as clean as it gets. This is as clean as it gets. I hope you guys really, really enjoyed the video. This was a very, very long sort of explanation for everything. I hope this made sense. I hope you guys enjoyed it. You know, I hope you guys, drop a follow, subscribe to everything, put on post notifications. What we did was we looked at the large tech stocks. The VIX was very far overextended. Crude oil is very far overextended. Netflix, we're seeing strength and everything. So, yeah, man, you can't argue with this. So, yeah. Tap, tap, tap. There's a little space for the block. How did you know where the support level is on silver?